In this first analysis video of the year, I want to show you a simple trade that happened in the Australian dollar 15-minute timeframe. The whole context for this trade idea was built around some simple and well-known concepts of technical analysis like support and resistance, and also on a few other more advanced ideas like sloped frequency lines. It's interesting to notice how different elements come together and converge to a single point in the chart to give us a trade opportunity. Observe that between numbers 1 and 3, the market created two vectors in a way that a higher high was produced. When this happens, we can say that a solid market structure is created. One of the purposes of a solid market structure is to serve as a reference point to make further studies in the chart, and also a place to put a safe stop-loss order. This is one of the reasons we pay attention to highs and lows in the chart in this way. Observe also that from point number 1, I drew a horizontal line. In other words, from the high number 1 I drew a line that later became a clear support and resistance line. Number 1 would be the most obvious display of resistance of such line, and number 4 would be the most obvious display of support of this line. In number 4, notice how price lands on this horizontal line, but it never closes above it. In classic technical analysis, this is usually called a switch. From the two observations we have so far, we can have an indication that this market has a clear upward bias. In other words, we have price action creating higher highs and higher lows, which is something that indicates buyer strength, and we have a horizontal line switching its quality from resistance to support. Beyond that, the support and resistance line has its origin in a rather important place in the chart, which was one of the highs that was used to establish the notion of trend in the first place. This would conclude this first part of the analysis, which is the easier portion. You will often find some difficulty in identifying a valid entry point in the market because the underlying frequencies that pinpoint market edges are simply not obvious, and the common tools of technical analysis are simply not good enough to make these areas visible in real time. This is where traders need to employ more advanced techniques to find these optimal points to enter the market. One of the many tools that we have here to do this precise thing is the sloped frequency line, which is further explored in the Market Maker Strategy video course. The sloped frequency line displays this underlying frequency that cuts through price action in a non-obvious way. In order to use these more advanced concepts in the most optimal way, a trader must be familiar with the nuances of price action, and how price really interacts with such lines. In this particular chart example, we can see an upward sloping frequency line that has its origin in the solid market structure marked by the number 2. One interesting detail here is that right from the start the frequency line catches the edges around the low number 2. This is a subtle hint of what the hidden angle of this market really looks like. The slope of this frequency line can also be determined by tying the origin of the line in number 2 with the lower action in the candles around number 4. Again, there is a specific way to draw these lines depending on the situation. In number 5 we have a very subtle clue that this sloped frequency line is indeed working as it is supposed to. Observe how price touches and rejects the line after we reversed engineered its upward slope using the recent historic price information. This is an optimal way of using the immediate past to understand the immediate future. You probably will not find these ideas in many technical analysis courses because they are subtle. Most traders seem to be worried about lines and tools that are devoid of meaning, which is a problem without any doubt. Ultimately, a trader must have one major preoccupation, which is to see lines and patterns that the rest of the market simply is not capable of seeing. That's precisely what creates the so-called trading edge. Your ability as a trader is predicated on your ability to see patterns and form connections between patterns. The trader who is able to connect all of these things together in a way that makes sense contextually speaking will be the trader that wins consistently over time. That can only happen assuming there is a solid trading ethic along with that, like good risk management and the awareness of highly important ideas about behavioral economics. Going back to the analysis itself, there are other dimensions here that we can explore to sustain the market context we already built with the previous observations. If we briefly analyze the relationship of momentum and price using the relative strength index, we will quickly identify that there is a clear simple hidden divergence between number 2 and number 4. Once again, this idea is in full agreement with the analysis we have so far. A hidden divergence in a situation like this indicates this market will continue to rise in the future, but keep in mind that you cannot use the divergence signals by themselves because they are too weak when considered in isolation. You must use them in context with other tools if you wish to extract the most out of these ideas. In this particular example, we could add yet another dimension of analysis, which would be the notion of market manipulations. However, manipulations are apparently absent in this chart because, as far as I can see, there is no indication of the presence of what I call the tridimensional axis of market manipulation. This is good because the absence of market manipulation makes the life of a trader a lot easier. You will be able to notice that when market makers are not acting, price tends to move a lot smoother, and high-quality trade opportunities are a lot more predictable. Summing up our analysis so far, we have the notion of an upward market bias by the observation of how major highs and lows are moving. We have a solid market structure that can be used as a place to put a stop-loss order. We have price action switching the quality of a support and resistance line in a quite obvious level. We have a reversed engineered sloped frequency line. We have a notion of a simple hidden divergence in full agreement with the previous observations, and we have the absence of market manipulation to make our lives easier. It should be clear to any trader at this point that there is not much doubt about the direction of this market in the immediate future. All of these elements are pointing up, and it would be really surprising if price started to fall after all of these elements, although anything is possible in the market. The real question now becomes how and where we can enter the market. This is a problem that haunts almost all traders, and it seems to be a constant struggle. Most people tend to look for completely objective answers about this problem, but I would say that knowing how to enter and exit the market is about 90% science and 10% art. There is an element of talent involved along with the technical knowledge, but you have to remember that you can develop your talent in this regard. This is something that everybody can learn how to do, but the point is that you have to develop it, and you have to understand that it is an art form to some extent. In this particular example, we have to incorporate all the previous elements of our context in the idea that this market is a lot more likely to go up than it is to go down. All of the previous elements can then be converged in the idea that the market is probably going to rise. From that point we can look for a technical way to enter, and to do that in the proper way, a trader must know the advanced lines I have been talking about. If you decide to rely on simplistic ideas about how to enter and exit the market, you will get what you deserve. An unsophisticated entry methodology will give you an unsophisticated entry. This should be clear to everybody, but our wish to oversimplify a complex thing almost always trumps our connection to reality. In the open trade you see in this chart, I used the notion of the sloped frequency line to enter the long position, and I used the solid market structure to place a stop-loss order. Price has tested the red sloped frequency line a few times, so the most logical thing to do is to assume that price will encounter it once again and behave similarly to how it has behaved in the past. In other words, we can expect price to touch the line again and reject it, going immediately to the upside after the rejection. This is the idea that made me trigger a market order precisely at the moment when price touched the red line in number 6. This type of entry style is a little more dangerous than triggering trades when candles close, but it has the added benefit of being a lot more precise. In other words, there is a trade-off between precision and risk as it is expected under normal conditions. The stop loss was placed below the low number 2 as it was identified as a solid market structure, and the target is simply the multiplication of the distance from the entry point to the stop loss to enable us to use a 1:3 risk-reward ratio. Notice how counterintuitive and scary this trade entry looks. Oftentimes you will feel that entering a trade, but you must get used to this feeling. Ironically, you will also find many opportunities that look very promising but end up being completely false. This is one of those many paradoxes we find in the charts, and that make the life of a trader a little harder. Let's see how this market responds in the next candles. As you can see here, price hit the desired target with success, rendering this as a winning trade. If you wish to learn how to trade like this, don't forget to check out the strategy store and take a look at the fractal flow strategy and market maker strategy video courses. If you enjoyed this video and want to support the channel, please click the like button, subscribe to the channel, and leave your comment below. Thank you for watching, and I hope to see you in the next videos.